Very good afternoon, everyone. The potential of India's economic growth is known to all. Today, as a country, we stand out as an oasis in desert with the prospects of being the fastest growing economy in the world among reasonably sized economies in the next 5 years if we are to go by IMF. As investors, while we are lucky or fortunate as Indians, I mean, we are in this golden period of economic growth. So we are naturally blessed by the prospects of this economy. How about choosing to invest in a sector that has the potential to even outgrow our overall economic growth or the overall GDP growth? Yes, we are talking about the Indian banking and financial services sector. So it is estimated that this strong growth is expected to be backed by the current state of under penetration as far as most of the banking services are concerned, also backed by the digital transformation that this country is seeing currently, wherein we expect these services to be taken to the length and breadth of the country, to the masses of this country. What's more, NPAs have declined from their peak levels in 2017-18. Now we are at a healthy state as far as the sector is concerned. Capital adequacy ratio is healthy. Credit growth is expected to pick up. So we'll be discussing all these in this call. So welcome to this webinar on Indian banking and financial services space. So to discuss all of these in detail, we have got Anand Laddha, who is our fund manager of HDFC Banking and Financial Services Fund. So we will be covering the sector in detail as to why it makes sense to invest in this space at this point in time. We'll be discussing the prospects as well as the valuation and other things in this call. So we also got Siddharth, who is our product specialist, who will be moderating this call. So after the session, post Anand's section of his presentation, you can type out your questions if there are any, then we'll take up those questions as well. So over to you, Anand. So the floor is yours.
Good evening, everyone, and thanks for spending your time for us, and also thanks for staying with the fund. So it's thanks to all the investors and distributors. The BFSI fund is now 1.5 years old, and by God's grace and by efforts of everyone, the investment team, and we have been able to do a much better job over here. So today, again, I will be re-emphasizing the fact that last 1.5 years back, I indicated to everyone that BFSI as a sector or would have a very good right moment to invest and have a very good cycle as such. I will cover today's presentation in discussion in two parts. First, I'll give you my view on the markets in general and BFSI sector. And in second part, I'll take you through some of the important presentation in the slide. Today, if you, like Ram rightly indicated, that today India is in a very bright spot. We have done significantly better, and this is due to two reasons. One, the way Indian government has managed the COVID shocks has been very significant and has been a learning for everyone globally as well. Second, the way we have managed our oil shocks due to the Ukraine and Russia war. Despite these two shocks, India has emerged as a very strong economy. Our economic growth has remained very strong in this all period of time. And this has resulted in our market outperforming global peers, both developed market, both US and China. So incremental, everyone will think what will happen going forward. While if you see, India over each decade has delivered very consistent growth. And therefore, we believe that going forward also, India will continue to deliver consistent growth, and we can expect a 12 to 15% return from our market. So if you look at our market, the broader market, our market if you look at, they are given the outperformance they had over last 1.5 years, they are trading at expensive valuation. When we say expensive valuation, this is relatively in relative terms. We are expensive today when we compare the US or the China market because those markets have corrected very significantly. So on a relative terms, we are expensive. But on if I had to look at on earning growth terms or on PE terms, the broader market trades at long closer to long-term averages at 18 to 19 PE multiple. Whenever we have seen all these things happen, uh, uh, we generally see the market will consolidate for some time holding on, and then the sector rotation starts. From here on, sectors which are where the earning visibility are very strong are likely to do very well. Like we have seen in auto doing very well, IT will do very well, and BFSI is one sector which will continue to do very well. Last 1.5 year, the sector has done very well. And I believe there are reasons to believe that the sector will do continue to do very well for next 2 to 3 years. So, and and which is why I believe that this is the right time to stay invested in this sector. There is enough room left for the sector to do well. One would argue why the sector should do very well. The sector has seen decent rally. If I take you to few slides, you can see that the sector valuation are not very rich. If you see BFSI sector per se, a large part of the profitability or the market cap in a sector comes from the lending businesses, be it NBFC, be it bank, be it HFCs. There are two reasons why a BFSI sector should do very well. First, due to asset quality outlook, and second, due to the credit growth. While we have seen the first leg of the rally being happen, which is the improvement in asset quality outlook, this rally started with improvement in improving outlook for asset quality started from ICICI Bank, SBI, and in the second leg we have seen a whole lot of smaller private bank and PSU bank participating in the rally. As and when everyone has seen that the asset quality cycle for India is behind, and that phase has re-emphasized because of the fact that even in COVID times, the asset quality outcome has been better. The slippages from the restructured book has been quite low. Therefore, we have seen the first leg of the rally being happen. Now, the second leg of the rally will happen because of earning growth visibility improving. That will be driven by two things. One, the lower provisioning cost. Second, trade growth improving for India. Today, Indian bank balance sheet are at significantly better position compared to what they had happened in the earlier two cycle. One reason of the same is that all the legacy NPA or the baggage of NPA has been taken care. Second, trade growth is there are enough reasons, seeds of improving trade growth have been there. One of the reasons why we believe that trade growth will remain stronger in India in the near future is because of the fact that India economy in general is well placed. India's manufacturing sector is expected to do very well. India's GDP growth is expected to do very well. Government push on infra, be it rail, be it road, be it metro, be it power, continue to remain very strong. Government scheme, which is drawing manufacturing, is the PLI scheme, will also create a lot of job, which means that next 2-3 years, we would have significant job opportunity being created in India. Second, we also have a decent inflation. While everyone globally talks about are afraid of higher inflation, country like India, for it, a decent level of inflation is very positive. As inflation of 6 to or between 5 to 7% is very good for India. I'd been emphasizing in my earlier call also, if someone was there, like a decent inflation helps in creating decent salary hikes in India. India is a large country with a large population in the salary segment. With a decent high inflation, one can expect a decent salary highs, and that also supports decent spend. As India moves from 2 trillion or 3 trillion GDP to 5 trillion GDP, we would see not only manufacturing doing well for India, even service sector doing well in India. So a more job would mean more purchasing power, would mean more demand for auto vehicles, more demand for housing, and in all this will support the earning growth, or the banking sector credit growth. Last cycle or last decade, if we see, India's credit growth has been very muted. FY11 to 22, India's credit growth has been very muted. Even if you look at the nominal GDP growth has not declined very significantly, but the credit growth has been very muted. This was largely due to a very weak corporate credit cycle. Now, with corporate NPA behind, I think corporate credit growth will start improving. Retail has always been strong. With both this element now being there, I think the visibility for a 14-15% credit growth is very strong, and it's likely to sustain for next 2 to 3 years. What it mean that banks earning growth or lending business earning growth will remain very strong for next 3 to 5 years. Second, to give you a context, Indian banks had a very high NPA, and today, if you see, the NPA number have declined. So to give you a context, in last 4 5 years, banks have written off 8 lakh crore of NPA. This is return of NPA, which means they are written off from the books of the bank, but the recovery process is still on. This is a large number. So this recovery, so whenever an economy does very well, the recovery from NPA also happens because the money supplier increases, also demand for asset increases. We have seen recovery in some of the large steel companies. We are now reading in newspaper recovery in the large power assets. 5 years back, no one wanted to bid for this power asset. Today, given the shortage of power asset, there is enough demand for this power asset which coming up. So this 8 lakh crore of return of NPA, even if one assumes a 20% recovery in this, which means 1.6 lakh crore, this is a very significant amount of recovery. While I believe that recovery will not happen in 1 year, but this recovery will come in 1 to 3 years. And this 1.6 lakh crore of recovery, which will happen in 1 year or a 1 to 5 year period, is very large number if one see in the context of the overall profitability of the banking sector. I'll have the profit numbers for the last top 5, top 6 bank, which is like HDFC, ICICI, Axis, Kotak, SBI, Bank of Baroda. This top 6 bank in FY22 reported 1.3 lakh crore of profit. So in that context, if I see overall banking system profitability in FY22 to be around 2 lakh crore, and if I believe that recovery from return of asset could be 1.6 lakh crore over the next 5 years, this itself is equal to the profitability of the banking system. So therefore, I believe next 3 years or next 2 to 5 years are there for the banking system. While in the call, everyone would have seen the market, how the tier 2 banks have rallied up, the public bank, the private bank tier 2, which have seen asset quality improvement outlook. And in this same period of time, if one see the high quality name, as we call it, has underperformed. That's the summary from my side on the outlook for the sector. I will now start taking you through some of the important part of the presentation. Uh, if you see the BFSI sector market capitalization, all through FY 2001 to FY22, all this period, the market capitalization continues to remain high and continues to increase as a percentage of overall market capitalization. But if one look at the chart very closely, 80-90% of this market capitalization comes from the lending business, be it banks, NBFCs, HFCs. So for India, the lending business still remains very dominant share. In terms of profitability also, if one looks at, the lending business has a very dominant share. But as economy expands from 3 to 5 trillion GDP, each of the sector like life insurance, general insurance will continue to add value, and they will also grow in line with the GDP. Thus, the sector offers a very diversified play in terms of different businesses with different market cap and profitability to play with. India, the big story in India is the penetration of financial service sector in India is low. And so also the case with many other sectors, maybe automobile industry, maybe consumer industry. And therefore, India remains a very growth focused market. If one look at India's penetration compared to US in each of the element, be it mutual fund, be it retail loan, mortgage loan, credit card, personal loan, they remain very low. And therefore, that gives you confidence that growth outlook for India remains strong. BFSI as a sector would do very well because the balance sheets of banks are clean, banks are well placed, India's fiscal position is very strong, and whenever all these 3 elements comes together, the credit growth in the economy does very well. And whenever credit growth does very well, the money multiplier in the economy increases. What I mean by that is that when bank balance sheets are very clean, everyone wanted to lend and grow. And when money starts flowing into the economy, even a marginal or a weaker borrower start great credit flows. And thus, default in general comes down, and it becomes a vicious cycle because the money flow in the economy has increased. And this money flow will support the earning growth for the bank. Therefore, I believe this is the right time to invest, or someone who had invested to stay invest. Someone who has not invested, don't think that they have missed the rally. I think next 3 years are going to be very strong for BFSI sector. And I believe this has now become a consensus call. If you look at any of the diversified fund, all of them would have 40% weightage to BFSI. If you hear any of my peer competitor firm, any mutual fund, BFSI, the sector everyone mentions that is going to do. So generally, the thought of investor are this has become a consensus call, and therefore it may not outperform the market. To that argument, if I look at, see, market loves earning growth, and if earning growth comes in, whether it be a consensus call or not, it will going to outperform. The second biggest factor, in last 1 year, FI has been a big seller in Indian market, and BFSI is one of the sector where they have significantly reduced exposures. And whenever a large fund has to allocate money to India, financial is the first sector where he will see the money. And therefore, despite this being a consensus call, I believe and I strongly believe that this sector will do very well. Earning growth for next 3 to 5 years will be very strong. And therefore, I believe this is the right time to be in the sector. The ROE of the banking sector from 2000, while we have data from 2005, if you see in the first chart, the ROE will move back to 15%. And the most important thing one should look at in the last cycle, the capital adequacy for the banking system was 12 to 13%. And this time, for the system as a whole, we are starting with 16, 17% capital adequacy, which clearly gives us confidence that banks' capital position is very strong to support growth. Also, the ROE of the system will move back to mean reversion. Therefore, I believe the earning growth of a banking stocks will remain very strong. If you see in the last cycle in 2002 to 2007, the earning growth of the sector was 33%. Today, we have all the element in place. NPAs are down, system credit growth has improved, bank balance sheet are clean, and therefore, I believe earning growth will remain very strong. The third chart in the table, in the slide, gives the expectation of the analyst on the earning growth for the next 3 years, which clearly means the sector will do very well. And whenever what I have seen that the earning growth of a sector remains very strong in those period of time, sector funds do extremely well. In last cycle, when the banking sector cycle was very strong, the sector has significantly outperformed all other benchmark, be it sectoral benchmark or be it broader Nifty 50 benchmark. Similarly, will happen this cycle. While in this cycle on last 1.5 years, Bank Nifty has not significantly outperformed, and it was only one of the reason I believe is because of the merger of HDFC Bank and HDFC Limited, which was announced, and the stock has consolidated for here in the last 1.5 years. From here on, as a merger is behind, I believe the index will significantly outperform the broader market, and therefore the sector as a whole will do extremely well. Another important I just wanted to touch in India, 2-3 fundamental changes have happened on the technology side in the BFSI space. One, we all knew of the JAM Trinity, Jan Dhan, Aadhaar, and smartphone penetration. The impact of all this has been very significant. You could see that the retail transaction or the digital transactions in India has significantly improved. The digital transaction today are more than 80-90%. RBI every month shares the data on the ATM cash withdrawal from the ATM. That has now become stagnant for last 18 months, which clearly means the penetration of UPI has increased. As the penetration of UPI continues to increase, money would become digitized, and that will flow into the banking system. That will benefit everyone. Today, if you see our P2M, payment to merchant, which is a big indicator of how digital economy is going, how wide the economy becomes. Today, India's P2M as a percentage of PFC is 28%. If you see this chart clearly, if I 13 we were at 3.5%, if I 17 we became, it doubled in almost 4 years. If I 17 from 3.5% we moved to 7.2%. If I 17 to FI 21 it further doubled to 14%. So it doubled in 3 years, and in last 2 years it has doubled from 14 to 28%. To give a context to everyone, P2M or as a percentage of BFC in US, it is 56%. So US being such a developed economy, such a wide economy, there also it is 56%. So it's a matter of time India would reach there. To conclude, I believe I believe we are into a very strong phase of economic growth. India's fiscal conditions are very strong. India's economic growth outlook is very strong. And in this time, the recovery in the economy is very broad based. And very broad based would support the earning growth of our markets. Under penetration of financial sector would give us a confidence that there's a long growth rate available for us. Technology, digitization has come a long way. Today, because of account aggregator framework, today, because of UPI, banks have been able or institutions have been able to give to loans to a small section of society also. In the past, giving loan to a small section of a society or to a lower section of a society, a smaller ticket size loan was not feasible. Today, with technology, it is feasible. Underwriting has become feasible. RBI now has a click database wherein they know which are the customer who had borrowed from multiple corporate who had borrowed from multiple bank and to whom which bank they have defaulted or delayed the payment. This database is shared by RBI with all the lenders on a regular basis. So right, we have heard about CIBIL for retail. Now we have Correlate for with RBI for corporate loan. All this means that our corporate NPA or our NPA cycle will remain pristine for a little longer period of time. And banking sector valuation, despite the run up, is not expensive. It is still below long-term averages or closer to long-term averages. What it means that the earning growth will remain strong for next 3 years, and therefore the return expectation from the stock should remain very strong. Therefore, I believe this is the right time to invest in the sector.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.